Hi, welcome to the Market Alert for Friday, the 7th of August 2015. And starting off in the 5-minute chart, so you can see the market selling off sharply to begin with. And the reason for this is there was a big sell order that hit the market. And you can see there from Zero Hedge, biggest plunge protection buy sell imbalance for 2015 halts market slide. So what happened was the market opened, started to slide to the downside, and either the PPT, the plunge protection, kicked in, or a big buy order came into the market. You can see off the Zero Hedge page there that this is what actually stopped the market from moving lower. So you see prices grinding to a halt. We see the market being tested there, and then prices being pulled back above the 17,450. We get a buy signal, which we see the market starting to move higher. Then again the weakness returns with a loss of 28 points. We then get a short. This also fails because of the PPT, and we see the market then being pulled back once more, and this resulting in a 36-point loss. Also, there is a massive divergence at the moment between commodity prices and also the stock market as well. And again, I'll just show you this. The Bloomberg Commodity Index against the S&P 500, it might as well be the Dow as well. And you can see this massive divergence. We've got 13-year lows in commodity prices as prices start to plunge, and this is not the way it should be for an economy that is so-called on a recovery, and should be moving with the S&P. The same as you see through here, you can see the recovery there. Commodity prices higher than the stock market there, and then you get this massive correction in 2008. So something's got to give, and it certainly isn't going to be commodity prices because of the global debt we have in the background as well. And if you want to see that, the 60 trillion of global debt, and this is how it's currently divided up. And if you have a look at this, you will see that the United States holding 29% of the global debt. But what's really interesting is United Kingdom 3.92%, whereas Greece, where all the focus seems to be at the moment, is 0.71. So you can see how bad it is if any of the other ones start to default. The whole of the so-called recovery has been QE money. It's found its way into the stock market and bankers' bonuses, and not where it should have gone, and that's fed through the system to start new business and things. This is why the economic figures are not coming out that brilliantly, and it wouldn't surprise me, more so than increase in interest rates, that we see more printing of money to keep this on track. But just coming back to the fall off in prices yesterday, crude oil, which also generally, if the market's bullish, so is crude oil, as are most commodities, because it shows higher demand for an improving economy, a growing economy. And you can see what's happened to crude oil over the last few weeks, and over the last few months has been over 70% decline in crude oil prices. Now, given that's the case, when we saw yesterday afternoon we got the sell signals coming in here, what I did was actually open up a chart of crude oil. And you can see I've got it side by side there with the Dow chart, and as you go through here you'll see me actually monitoring the two. So you can see where crude oil started to move up, this bounce here. You can see that the bounce in the prices is where we had the 36-point loss, so I'm 64 points down at this point. And then you see the sell signal coming in, and crude oil price is starting to slide again. We get through the, I'll just bring this back. We get through the, that's it. We get through the support here in the crude oil market. We go through the scalp in the marked up price there, and then you see prices continuing lower and all the way down to this point. By trailing the stop is a 64-point profit, 66 actually to be precise, pulling back the 64-point loss. But down in the lows here we were at over 81 points of profit on this trade. And as you see crude oil prices rallying there, you see the Dow being pulled back because the two are interlinked and intertwined there. So you'll see, as I just go through the rest of this for the session, that crude oil starts to go down again, and you can see prices starting to move lower. Not trading the evening session, haven't done for a long time, which I've told you about. And you can see there the price is coming back up around 15-16 points on these PTIs here. But then crude oil price is running out of steam once more, and you'll see that prices start to move back to the downside with crude oil, and that's as far as I got there. So you can see I'm still holding there, but prices did actually move back to the downside in crude oil, and the market just holding at the 17,400 level. So sometimes it pays to know exactly what's going on in the background as well with regards to these markets. So crude oil should actually rise with the Dow. All commodities should rise with the Dow. And at the moment we've got this huge divergence, and something has got to give, as I said earlier. And for me, it's going to be a massive correction in the stock market. You've got all of this debt in the background as well. Global debt of some $60 trillion, 59.7 trillion. Now that's without the banking derivatives of 1.25 quadrillion. That's right, 1.25 quadrillion as well, which derivatives, for every winner there's got to be a loser. So I have no idea if that has an issue, who's going to actually pick up the tab on that one. But again, just knowing what was happening yesterday, the crude oil market on the slide. So it was a case of where we had a dead cat bounce in crude oil prices. That is that prices rise and then they head back to where they started for. The expression is dead cats bounce, but they don't run away. So here you see the cat bounce, doesn't run away, and prices end up going back down to where they were. In the ETX software, it's NYMEX USB. There you can see the price. There's the chart. You can see prices of just holding in the 5-minute chart. In the daily chart, different picture altogether. Let's just expand this, and you can see prices there just sideways for today. But expect lower prices, and also if we just go back to zero hedge, we've got Goldman Sachs also talking about storage is running out for crude oil as well. There's too much supply in the market, there's no growth in the economy, and oil prices are likely to continue to move lower in the short term. So this is going to put downside pressure on the Dow as well. But again, for me, this speaks volumes, this chart. You can't have this. It's not possible to have the so-called perception and sleight of hand, effectively, of the stock market going up. And the reason this has gone up, as I said earlier, is that the QE money found its way into the stock market and banker bonuses, not into the economy. But what happens is, of course, this is why Yellen's talking about raising rates, because there's a bubble in the stock market. Well, the bubble was caused by the $3 trillion that they printed in the US and pumped into the market. So the only people that have benefited has been the bankers. Whereas in the real world, you can see the demand for commodities has fallen off sharply. You've got the debt in China, you've got the crashing of the stock market in China, and also there was another good article in Zero Hedge, if we just go back, if I can find it quickly, about the amount of trading accounts that have been closed in the last few weeks as well. I probably just can't find it because I want it straight off, which is generally the case. Let's just have a quick look through here. I'm sure it was in on the first page when I was looking this morning. And there we go. 1/3 of all Chinese gamblers have shut their equity trading accounts, so you can see the effect. So China is not they've again the actual contraction of the Chinese economy has been significant as well, but again they're not reporting this on the news. Most people are still under the illusion that China are moving forward, they've got massive growth, and it's simply not the case. They have massive debt as well. If you look at the debt situation, there's 6.25 of debt in China. They're not reporting the debt fully either at the moment. It just keeps getting leaked. But there you can see the total share of accounts with transactions has switched considerably in the last few weeks. So everything is not as rosy as it would appear to be in the mainstream. And I also noticed that Carney yesterday backtracked once more. Everything he's ever said he's going to use in order to increase interest rates, he's never actually done since he came the chairman of the Bank of England. And yesterday I see in the Telegraph business section that they're going to delay the increasing of interest rates as well. Well, what a surprise, because they know that if they increase interest rates, there's going to be this bubble, this sort of balloon or whatever. You put a pinhole in this, eventually it's going to actually start going in the other direction. Whereas at the moment, if stock prices are rising, the same as house prices, classic cars, wine, diamonds, all of these bubbles that we have at the moment, it gives the perception to the majority of people that everything is fine and dandy, when it actually, when you lift the look under the bonnet, you can actually see there's a problem with the mechanics of the whole thing. Just going back to the markets then, so in the daily chart we see prices moving lower. Again, we've got this sort of increase in volume. The market coming off the lows, that 17 at 3,096 that we saw was tested yesterday. I'll just delete this line, and the market finding a bit of support here during today. In the news, 3 p.m, we don't have anything today. All the news will be done and dusted by 1:30. So it's Friday. We could have a quiet day, but certainly at 1:30 the non-farm employment is a biggie for today. This one could move the market. If we get any sort of rally in the market today, it's going to run out of steam as well. So any potential sell signals will be better than buy signals, unless the non-farm roll figures are better than forecast and the market is manipulated back to the upside. But generally, because of the downside that we've got in the background now, I would expect any sort of sell signal to be the best side on this market. And finally, in the implied volatility, 12.05 for Wednesday. For Thursday, this 12.97, of course, which you'd expect, 150 point drop on the open yesterday until the PPT came in, supported the market, or somebody was daft enough to buy the market with a big buy order. Right, that's it for today. Bit of a long one, but hopefully give you a background of what's going on as well, why you're seeing the weakness in the Dow and how you can use this to your advantage in recovering a position like yesterday when the market didn't know what to do, because when the market opened it was hit by a big sell order. Right, that's it from me. I will see you in Monday's edition of the Market Alert. As ever, thank you for your support and also for watching. See you in the next one.